Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with John Davies, Investment Director at Seneca Partners. Hello, John.
Good morning.
First off, could you just tell me a little bit about yourself and who Seneca are?
Yeah, of course. I joined Seneca around just over 3 years ago. I've got a background in accountancy, transaction services and corporate finance, mergers and acquisitions. In terms of Seneca, brief history, Seneca was established in 2012, three very seasoned professionals in an office in Haydock in the northwest. Fast forward 6 years, we now have over 700 million under management across 5 offices and over 60 members of staff. Now, in terms of the services we have different pots of equity, different pots of debt, and also an award-winning corporate finance advisory service. Very much an entrepreneurial business in our own right, and SME focused across the board.
So the Seneca VCT, that's a new one, isn't it?
Yes and no. I mean, to put it correctly, we've actually launched a new class of shares within an existing VCT called Hygea. Now, the reason we did that was because it's very difficult now to launch a brand new VCT from scratch, and it's something I'll come on to later. Importantly, the way we've done it has allowed us to come into an existing shell with a very low cost base, with a board and VCT structure already in place, which saved us setting up ourselves. But most importantly, it allows us to pay dividends from the outset. Now, following our first allotment of shares in August, the VCT's name actually changed to Seneca Growth Capital VCT PLC, which means it's very much now a Seneca shell.
And do I get access to any of the existing investments, or is it completely new?
It's a good point. It's a good point, and it's one that we should have clarity around. So there will be 2 existing. There's one existing share class already there, and there'll be ours as well, and the 2 are completely separate. So the previous Hygea shareholders will benefit or not from the investments that they're invested in. The new B share class, which is our share class, will only benefit from the investments that we make going forward, and the 2 will remain completely separate.
No disadvantage to the existing Hygea investors?
Not at all. If anything, they get an advantage because they're now sharing a cost base.
So why have you decided now is the right time to set up a VCT?
In terms of VCT, I mean, I'm sure you're aware that over the last 18 months there have been a raft of legislatory changes that have shifted the VCTs from where they would normally operate, where they've been able to do MBOs, leveraged deals, effectively operate like a private equity fund. The changes in legislation have now put them very much in the growth capital space, alongside where EIS has resided for a number of years. So we've looked at the industry and thought, well, arguably we're better placed than existing VCTs to operate in this market, because that's where we've been operating for the last 5 to 6 years.
So you've managed a EIS portfolio very successfully. What's different in managing a VCT?
Right. So it's important probably to note that we've raised and deployed over 50 million under our EIS portfolio. That's been invested across 70 rounds into over 40 different companies. We've had 9 successful full and partial exits, and we've only had 3 write-offs to date. Now, in terms of what's different between the VCT and the EIS, that in terms of what we're investing in, it's going to be very similar. In terms of the way the funds run, they will be slightly different. VCT is obviously a listed vehicle. It can pay dividends. There's a guaranteed buyback after 5 years versus where EIS sits. And I think more importantly, it's the spread of investments that you get. Through our EIS portfolio service, you would only benefit or not from 5 different businesses that we invest you into. With the VCT, you have a far more diverse portfolio of investments.
You mentioned dividends, and I know you've got the ability to pay dividends. Are they likely in the first few years, or is the money you're just going to get on with investing the money?
There's an expectation that we will be paying dividends in the early stages. That'll be a board decision at the time, but in order to remain competitive in the market, it's something we need to be doing.
So let's talk about the type of investments you're looking for.
Okay. So what we've looked for previously through our EIS funds is something we're looking to replicate in the VCT. We've been successful in doing that. Now, the key features I think for any investor is that we aim to invest funds around about 50% into AIM listed businesses and 50% into private limited businesses. The AIM businesses obviously give you the liquidity, or as long as there is liquidity in the market at the time, board representation, the proper corporate governance, but there's a trade-off with that versus the private companies where we get more controls around them. Also, our deal flow is regional. We pride ourselves on the deal flow that we have. We look at around about 10 investment opportunities a week, so around about 500 a year, which means we can be very selective in terms of the business that we do. Because we're regionally focused, it means we're out of the city where there's a lot of competition from VCT funds and also EIS funds. For the opportunities that are out there, we feel we get better value from the regions.
Do you want to just talk about a few of the EIS investments that you've made recently, so to give investors the idea of the sort of things you like?
Yeah, okay. So a few that we've done. One we've done recently was Super Carers, which is a tech platform that links customers or patients or families of the elderly to the actual care provider. In that industry at the moment, you have very big agencies who take a lot of fees. So what this platform does is cut across that middleman. There's no need for the middleman because it's actually connecting the two different parties, and allowing the customer, or it could be the child of the elderly relative, to actually manage that care themselves and pick the right carer for their parent. The carer gets paid more, and the customer actually pays less. Quite a disruptive business, a really strong management team, which is what we always look for, scalable because it's a tech platform and it's in a growing sector. Demographic is obviously ageing across the population in the UK, and the need for care, particularly home care, because people want to avoid actually going into care homes, is growing and growing and growing. That's quite an exciting prospect. Another deal, Bond Mason. Bond Mason was a deal that we went into in March. Another tech platform, quite a flavour here, that's scalable. And what Bond Mason offer is customers a spread of different loan, whether it's peer-to-peer lending opportunities. I mean, it's something that Seneca do as well in terms of the bridging work that we do. But there are maybe 150 different bridging businesses across the UK, and rather you yourself researching these bridging companies, what Bond Mason has done is done its own due diligence on those and picked out the very best with the most robust investment strategies and checks, and so if you provide your money to Bond Mason, they'll split that money across 50, so really diversifying the risk for a customer who would normally just end up going into one of these bridges. Again, a really strong management team and a scalable business.
So those are newish investments. What about ones you've successfully exited from?
Right. Okay. So I mentioned before that we've had 9 full and partial exits, but that was only up until March 18. They ranged between 1.08 times to 9.7 times money multiple, which is great. We've also had 3 write-offs, but across 70 investments. That's not a bad record. In terms of recent exits, since the end of March, we've actually exited a further 2 businesses. They were both AIM listed. One was Gear for Music and one was PTSG. Gear for Music was a 5.2 times money multiple return, and PTSG was a 3.6 times money multiple return, which is what you generally probably expect from private equity funds. We've also had a couple of private exits that were around about 2 times money multiple return, and at the moment, our focus is on exit as well as investment, but on exit.
EIS is pretty risky, as everyone knows. What do you do to minimise the risks? And you say you've had 3 failures. Would you expect a typical number of failures each time you build a portfolio? Well, in the past when you would have built a portfolio, but now for the VCT?
Yeah, look, I'd be lying to you if I didn't say that it was it's not without its risks. As I said before, we've had 70 investments rounds previously, 3 failures, but clearly we've had more winners than losers. We treat every single investment in the same way. We try to have we generally have board representation. If we don't have board representation, we always have the necessary controls within the legal agreements, particularly on the private limited companies. We're restricted somewhat on the AIM businesses. Whenever there is an issue at business, we usually know before it happens, and so we can be proactive rather than reactive, and try our best to make sure that business is put back on track. Sometimes that is, sometimes you can, sometimes you can't. There will be failures going forward, but like I said, we've had a good track record so far with only 3 out of the 70 investments that we've made. So
John, if I want to invest in a VCT this year, why should I invest with you?
Right, Alex, I'd be happy to take your money. But I think it's quite simple, really. I think if you're looking for an alternative VCT that has a track record in growth capital investment, a regional player with regional deal flow, a very good diversification across the investments that you'll be put into, because we're sector agnostic, and also a nice blend of AIM listed versus private listed businesses with an experienced management team, then I think Seneca's for you.
John Davies, Seneca Partners, thank you very much.
Thank you.